Hi, I am Joe Halpern, Chief Investment Officer of Fountainhead. Welcome to Investment Wars. At Fountainhead, we regularly incorporate debate into our analytical process. On this podcast, we seek to have meaningful, respectful conversations on major themes within the economy and markets. Will globalization end? Will China pass the US in overall GDP? Will robots take over the world? This is our effort to better understand the nuance and complexities of financial markets. Today, we have the privilege of having Professor Nick Bloom as a guest on the show to discuss how to measure and navigate with uncertainty in our economy and financial markets. Nick Bloom is the William Eberle Professor of Economics at Stanford University, a senior fellow of SIEPR, and the co-director of the Productivity, Innovation, and Entrepreneurship program at the National Bureau of Economic Research. His research focuses on management practices and uncertainty, which is what we'll discuss today. Welcome, Professor Bloom, to our show.
Joe, thanks very much for having me on.
So I'm going to prompt here. Wednesday, April 2nd, newly termed Liberation Day, President Trump unveils tariffs directed at countries of which we have trade imbalances with. These tariffs disproportionately affected our allies, and the market immediately declined. It resulted in the greatest two-day destruction of market wealth ever. More concerning were events in the bond market, and we at least we believe that probably ultimately resulted in a 90-day pause. The math on tariffs is actually relatively easy. Everything will become more expensive, and you can figure it out. You can do the math around it. If there's a 25% tariff, it's based on costs, and it increases inflation. And when you have increased inflation, when you go to Economics 101, when things become more expensive, you tend to consume less. You look for substitutes, but there's lower consumption. So what all this did, this tariff war that was initiated, really created a high likelihood of entering a recession and potentially a depression. There's a more complex element that comes out in the wash here, and that's what we really want to explore today, which is uncertainty. Nick, can you please define uncertainty as relates to economics and financial markets?
Sure. I guess there's a Main Street and the Wall Street version of this. So if I start in reverse with Wall Street, the classic measure, and I used this in my PhD back in the late 90s actually, is the VIX. So the implied vol in the S&P 500 looking forward 1 month. And of course, there's a whole vol curve going out to 10 years and, going to a day, etc. So effectively, in some ways for Wall Street, maybe a typical measure would be the volatility of the S&P or NASDAQ, whatever you're measuring. So that, bounces up and down. If you look at the VIX going back 40, 50 years to the extent we can, I think it starts in the 1990s, the first data we have, or late 80s, you see it surge dramatically in the global financial crisis with the COVID pandemic. Right now it's high. It's not at kind of epic levels. The VIX is kind of 40-ish now, but it's certainly gone up to kind of 80, 90. So that's a Wall Street version. The different version I call Main Street is you could run surveys. I'm actually running surveys. I have one with the Atlanta Fed. I have one in the UK. The problem with surveys is they don't go back very far. They only, the data only starts when you ran your first survey. And so what we've been doing to get a long-run perspective is look at newspapers. So I kind of skip a lot of the details, but at its simplest, we're really searching for the frequency of newspaper articles which talk about the economy, which talk about policy and talk about uncertainty. Mention the word uncertain or uncertainty. That thing has really taken off. So yes, that, newspaper, we have this thing called the Economic Policy Uncertainty Index. That was certainly high in 2008. It was certainly high with the COVID pandemic, but currently under the Trump administration, it's also surging, and it's at levels we saw in those two previous crises. So Main Street, or put it, the media, seems to think that uncertainty is extremely high right now, and we're talking in late April 2025.
And what is it like? And why is what uncertainty do they have? Is it just the direction? Anything? Or
I think there's a bunch of stuff. So one is actually, I've talked to a lot of journalists recently about why is there a bit of a disconnect between Main Street and Wall Street. So Wall Street, as in stock vol and implied vol, haven't risen nearly as much. And partly is maybe Wall Street's more calm. Partly, if you look at the equity markets, they're kind of long tech, they're long finance, they're short some sectors. And so that may also be another reason. In terms of what the uncertainty is. And if you look at newspapers, there's a bunch of stuff. One is obviously tariffs. You mentioned, tariffs narrowly written down is kind of, is effectively a tax on transactions and, what that tax rate is going to be. But it's potentially very big. For example, it may completely stall out trade with China. And we saw actually under the Trump first administration, whenever that looked like there was a US-China trade war about to kick off, the stock market would slump. So there's a lot of American companies that are making large amounts of profit, frankly, from producing, buying, selling from China. So if you stop that, that's bad for their stock price. Secondly, is over immigration. So immigration is actually a big deal for long-run US growth. So currently US replacement rates, so we have 1.7 kids per couple, which isn't actually enough to generate population growth. And immigration, at least the last couple of years, was running at about 2 million a year. Now, you can argue whether that's good or bad, and that's a different debate. But the bottom line is it was driving a lot of growth. And if you're an American company, like Walmart at the bottom end, let's say, hiring folks to work in stores, or Google hiring scientists, in both cases, if immigration stalls, your wages are going to go up and your growth is going to slow. And then I think the third set is more of a rag bag of things like attacks on universities, stripping out funding for NIH, NSF, etc., stuff that, again, in the long run drives growth. So I think the markets and Main Street is like, what is going on? They're not certain whether this thing is posturing and will disappear and, Doge is just a flash in the pan, or whether all of these policies that we've seen in the first 3 months are going to be for the next, 3 years and 9 months, in which case that is tremendous turbulence. So the US, if there's this saying that the 21st century, as in 1900 to effectively 2000 was America's century. America did fantastically well after World War II, saw amazing growth rates. And a lot of it's founded on free markets, free trade, globalization, what's been called the Washington Consensus. And I think there's genuine concern that's over. And if that's over, growth's going to slow and, stock prices, the dollar's falling already. People are nervous about treasury debt. So that, I think, is the big uncertainty, is where we're heading.
Got you. So to summarize, and I'm going to start with Main Street, with general economics first, and then Wall Street. To summarize, it's this uncertainty of where we're going to end. And so taking tariffs as an example, right now there are 10% global tariffs and 125% or 145 or whatever it is in China. And that's something that's certain. What's uncertain is what will come after the pause, or where will we really go with China? Because I don't think anybody believes that they will stay there, even though I'm not sure what people expect. So just on tariffs, before we get into some of the other but that's the uncertainty, right? The uncertainty is where are we going, and then how do we plan around it?
Exactly right. So in, a year ago, there were tariffs, but they were relatively low and, they didn't change. So it was a thing you didn't worry about. Whereas now you've got to factor in this potentially large variance in these tariff rates. And it's also generating all kinds of other weird second order effects. So a friend of mine that works in ports says there's a bunch of goods that are accumulating in West Coast ports because they've been shipped, but the receiver doesn't want them because in order to take them into the country, you have to pay tariff on them, just left them. So now the ports are gumming up and there are ships floating out in the Pacific. There's all kinds of odd secondary effects of this. But yes, nobody's entirely sure. I don't know. It's a good question about whether the White House has a big master plan. One view is it has a master plan that it's moving along. The other is it's part of a negotiating strategy. But when you're negotiating with 100 plus other countries, anything can happen. And those countries are having elections and wars, and they've got their own uncertainty. So my sense is it's more of the latter. It's kind of a negotiating ploy, which means it's genuine uncertainty. I'm not even sure if President Trump knows where this is going to end up.
Yeah, no, that's really fair. And so just kind of playing back that last comment, you could just state it's apolitical, and depending on where you fall on the political spectrum, you could like what he's doing. Not, it doesn't make a difference. There's uncertainty. Even if the grand plan is, listen, we want to get everybody to the table, and we want to cut the deals we want to cut, and we know what we have. Because we're not at the end game, we have that. Something that popped in my brain, even while you were speaking prior, politically speaking, most of the time people like when an election occurs where there's gridlock. When I'll take back from people, I'll say Wall Street. Since we've created Main Street and Wall Street, we'll go with Wall Street. Wall Street likes gridlock, political gridlock. They like when a Republican wins the executive branch and Democrats win the Congress, or vice versa, right? They like that, and the reason they like that is because you don't have uncertainty, because there's no change. People could complain all they want about gridlock. Wall Street kind of likes it because it's like, all right, nothing's going to happen, so we kind of know the agenda. Here we have this massive uncertainty around the tariffs. And then, as you mentioned, there's also just by definition, because we've allowed, I've looked at these numbers, so there's a million immigrants allowed annually, legally. I can't speak to, you may be able to speak to it because you're closer in terms of visas to students and how they play with the workforce, because I think there's a lot of rules there. And then there's been probably at least 2 million illegally over the last few years, and that's just a reality that those people work. So to the point of more people equals more growth, that'll go away, and where are we getting the people from? So, okay, great. So let's, now that we kind of have that.
On the uncertainty, one reason I think it's likely to persist is traditionally politicians like to portray this air of stability and calm. So, I worked in the UK finance ministry, the treasury for a bit, and for most of that time, I should be clear, that's an apolitical position, but for most of the time I had Gordon Brown, who was the chancellor. And Gordon Brown, I remember, because I was in the treasury, would give all these talks on, the end of boom and bust, and I am the, stability, etc. We currently have an administration that has, has won a pretty convincing mandate. Obviously, they have the presidency in both houses of Congress. So traditionally, where you see that, they have power, but you'd think actually they could get their, their policy set pushed through, and that would, calm things down once they enacted everything. What's unusual is they have an explicit strategy to dominate media headlines. And in order to dominate media headlines, you have to keep announcing stuff. Now, you can argue whether that's right or wrong, but, several people in the Trump administration have said, look, we want to be in the news, we want to be leading, making the news at the top. So kind of every day they have to announce something. And I was talking to a journalist at The Economist and saying, look, your front covers are always right now have Donald Trump on it. Can you not focus on something else? And he was saying, well, yes, would like to, but he's just so dominant. He just, makes everything. So I think it's a combination of a very powerful administration and one that wants to keep surprising us. So I don't see actually this changing particularly, because if you want to dominate the media, which, to be clear, has been successful for Trump. I mean, he's on his second administration, and so I suspect he'll stick to that strategy. If he sticks to that strategy, he's got to unveil a new surprise more or less every day, every 2 or 3 days at least, for the media cycle. And so the first 3 months is a pretty good guide for what we're going to see for the next couple of years.
Well, that's great. I want to come back to it, and I thought long and hard of the title of this podcast, and it's how to measure and navigate market uncertainty. The measurement part we're going to talk to now. We're going to get to navigation. Maybe you could give us a hint or two of how things have played out in the past. But first, I want to, you referenced the Economic Policy Uncertainty Index, which you're a lead researcher and a co-creator of, and you referenced newspapers. Can you give us just a fuller idea, highlight exactly the methodology, like what kind of goes into the index measurement, the index reading?
Sure. So there's a variety of them. I'll just focus on vanilla, the kind of the highest profile. We actually have a daily index, which, Bloomberg carries, Fred, Reuters, etc. will carry. What that does is it scrapes all the daily newspapers we have access to on something called Access World News. There's over 1,000 of them. So what are these? These are typically local newspapers. I live in Palo Alto, and we have something called the Palo Alto Daily News. That probably no one's even heard of it, let alone read it, but it's one of the 1,000 out there. So we scrape these, and we are scraping them for the share of articles that mention the word economy or economic, they mention uncertainty or uncertain, and they mention one of 6 policy words, which are like regulation, Federal Reserve, White House, etc. And that's normalized, and we now can generate from that daily, weekly, monthly indices. That looks very sensible, so I plotted that thing. In fact, we can historically go back to, you can get newspapers and archives. You have less of them, but you can, in theory, go back to about 1880. And every time there's a spike in those indices, it's things like the Cuban Missile Crisis, the assassination of JFK, World War II, the Tet Offensive, all kinds of stuff, the assassination of McKinley. So that index looks extremely sensible. It's highly correlated to the VIX. So on a day-to-day basis, it moves very closely with the VIX. I have a separate index, which is called the World Uncertainty Index, which is a slightly different idea. That takes the Economist Intelligence Unit's monthly country report. So the EIU, the Economist Intelligence Unit's report generates once a month about a 30-page report on around 150 countries around the world. That's aimed at like multinationals, private equity, VCs, investors. So it's kind of dry and boring, but that's a good sign. In a sense, it's 30 pages of discussion of the economy. And the World Uncertainty Index scrapes that and just counts words like uncertainty and then does some other variation. So that's a different version. Why do I mention both? Well, the Economic Policy Uncertainty Index uses as its corpus 1,000 daily newspapers. So you could claim, well, look, it's a bit, if you don't like the media and you worry that, I don't know, there's a mainstream media bias, you can kind of ignore that one. The World Uncertainty Index, I think, is different. It's monthly, but it has the upside. It's from a dry, boring Economist Uncertainty, the Economist Intelligence Unit. In both cases, they actually look very similar. They're both at incredibly high rates right now. So when Trump won the presidential election and kind of swept Congress back in November 24, they both rose a bit. When he took office in the beginning of January 2025, they started to rise. His agenda has become, in some senses, maybe early on people expected some radical stuff. It has become, I think, much more radical than people thought and more active. And so these indices have been surging and going up and up. And so by April 2025, they're incredibly high levels. They're both basically the same as the COVID pandemic or the global financial crisis.
So I wanted to get to the COVID. Well, first, actually, before that, so the monthly is newspaper clippings, variance with economic surveys. I thought there was a third one. Is there anything around policy, at least for the U.S. one?
Well, okay, so it's like an ice cream shop with 57 flavors. So
okay.
We did have a monthly index, which used a bunch of budget changes and CBO data, etc. I would say the two main ones I would look at is the daily, which scrapes 1,000 newspapers, and the World Uncertainty Index, which scrapes the Economist Intelligence Unit. The latter is produced jointly with the IMF.
Got you. Okay, great. Okay, so let's go to COVID. COVID's a great example. It's unfortunately still close enough for people to really remember it. And when I looked at the monthly U.S. uncertainty index, it spiked in March. It went really high in March 2020, and that makes sense to me. And then in May 2020, it spiked even higher. And then it kind of came down. It's interesting because the index looked a lot like, waves, like the market looks in a lot of ways, where things move up, they decline a little, they move up again, they decline a little, and then things play out. But here you had three spikes. You had almost like, in technical analysis parlance, a head and shoulders, if you may, within the uncertainty index. Do you believe you have, did you guys analyze it and say this is why this shape happened? Or are you able to give us any kind of insight into that, like why that happened, why it spiked a little later?
I mean, one thing is the news got worse. I mean, if you look at markets, they kind of bottomed out in late April, early May 2020. Early on, I think lockdown, we can all kind of remember what it was. I was teaching in late March 2020. And I told my class, we went to remote teaching. This is probably March 20th, 2020. Hey, I'm not actually going to do Zoom teaching because we're going to be back in person in 4 weeks and I'll return to teaching it then. So early on, everyone just thought it was 4 6 weeks. By the time you get into April, late April, it becomes clear it's much worse. This lockdown's going to extend. And then into May is when, in some senses, the uncertainty also remains very high as about what will happen. There's a lot of fighting about do we have longer lockdowns, shorter lockdowns, how to play with vaccines, etc., whether the government's going to do stimulus. So not surprisingly, while the dive into the pandemic was fast, it wasn't initially that clear how bad it was. It's a bit like the global financial crisis because Bear Stearns went under, but that was kind of the ripple in the water of kind of a Jaws-style shark attack. You see the fin, and then, you see the full horror of what's beneath. So in both cases, actually, uncertainty built. It tends to spike relatively early in cycles. So if you think of, a downturn typically will last 9 months. Uncertainty is typically worse in the months 2 or 3, so early but not right at the beginning. And then it subsides as, the horror of a downturn takes shape. And then actually in expansions, you see uncertainty goes for relatively low. So if you look at 2011 to 2019, uncertainty was quite low. The 90s, it was quite low because growth was pretty good. It was actually it wasn't so bad running up to 2023, 2024, it was kind of falling before the current wave, which is induced by all the Trump administration policies.
Got you. And then, so I think you referenced this earlier too. You had authored a study titled "The Impact of Uncertainty Shocks," and as referenced, it looked at the Cuban Missile Crisis, JFK assassination, et cetera, et cetera. This analysis, did this provide like a structural framework in analyzing the impact of these uncertainty shocks? Like, is there something we could expect from it all that plays out the same?
I tell you the findings, and in some ways, there's nothing new under the sun in economics. So this goes back. It was built very much on work. Ben Bernanke, in his PhD thesis, actually had a similar paper. Christy Romer had a paper on the Great Depression in the 30s. So the intuition is really straightforward. If you're a consumer, let's start off with, me or you, thinking about buying a new car, a new washing machine or television, or maybe, moving apartment or new furniture. If you're very uncertain, you tend to pause. Reason is you're fearful of losing your job. Things could get better, but you definitely don't want to be left, having bought an expensive car and then regretting it the next day. So consumers tend to pause a lot on spending, particularly consumer durables. Now flip to the business side of the economy, what we see is firms take a similar approach. So, for example, when they're uncertain, they tend to pause investment. Investment's kind of the canary in the coal mine. It's the first thing to drop when uncertainty goes up. They're also more likely to slow down in hiring. So, Stanford University currently we're currently in a hiring freeze, and nothing, bad may happen, but we're just nervous and we don't want to overhire and make a mistake. So broadly speaking, what you see quite clearly in macro data, and this goes back over decades and across countries and industries and individual firms, is when uncertainty goes up, the general public, us, stops spending, particularly on durables, and firms stop particularly investing, and they also slow down hiring. And collectively, that generates a recession.
Got you. Okay. And so there's a cost there, and then it has to start. It doesn't have to start again, obviously. And historically, it has started again. And so it starts again presumably, when people have enough confidence that there's a clear picture out there. So going back to COVID, for instance, I guess, once you're like, okay, we're going to have a vaccine, or we're going to get out of here, we could start consuming again. Is that kind of
exactly right? So okay. There are two types of kind of drivers of recessions in economics. One is just bad news. So imagine, for example, you're just told, policy is going to be bad, or you're tariffed permanently by somebody else, or there's massive strikes, and that just generates a recession, and you gradually recover. But it's not like you ever really get back to where you were before. The second is if it's pure uncertainty or very uncertain, people all pause. But of course, a year after that, imagine uncertainties remained high, you've paused, so firms haven't hired and invested. All of us, haven't bought a new car. Our cars and washing machines are getting a little bit old. And if uncertainty falls back down again, there's kind of a rushing back to make up for lost time. So it's kind of like a river. You can dam a river, but of course the water's building up behind the dam, and when the dam goes, it all floods back down. So uncertainty typically, in these models at least, generates very sharp recessions, but they don't last too long. And once the uncertainty goes, you see this snap back because there's all this activity pause. It's a bit like Milton Friedman, Nobel Prize winning economist at Chicago, had this what he called the guitar string theory, which is the harder you pull the guitar string down, the faster it snaps back. And it actually works quite well for these uncertainty recessions. Now, typically, in research, what we see is what's happening now with tariffs and the current administration. The Wall Street and the economy sees these as bad news and also as uncertain. So it's kind of a double punch. Lots of firms involved in trade or retailers are like, oh my gosh, costs are going up, tariffs are going to have to pay that. Effectively, it's a tax, really. A tax has gone up. So, that's bad news, and we're also uncertain to how it's progressed. So collectively, those are it's clear that growth is going to slow down through 2025. Whether we're going to hit a recession is a bit of a technical debate. Recession is, 2 quarters of negative growth. That's less obvious, but certainly growth probably on average is going to head towards near zero with, the average prediction. And that is because of both uncertainty and people are fearful of what tariffs would do.
Yeah, fair enough. And so with uncertainty and navigating uncertainty, I guess there's, in my brain, there's kind of two pieces going on, two components here. One component is it just stopping, meaning like, okay, tariffs are figured out and this is what the tariffs are. And so I guess figuring out how to live with whatever that quote unquote bad news is, right? So COVID occurs, I'll use COVID as an example. COVID occurs and then you start figuring out, okay, what can I do and can't I do under these COVID rules? And then eventually life got easier and easier. So I guess it's a long way of me trying to figure out how much of it is just humans, Main Street, Wall Street, just getting used to this reality of uncertainty and figuring out how to navigate it because we're all pretty creative in that kind, and how much of it is kind of just solving it, right? Navigating it versus solving it.
I mean, there is a pause. You see, classically, like if I want to predict investment and I tell you, you tell me uncertainty's gone up, I can predict the company is going to cut investment by 10, 15%, probably cut hiring by a few percent. People, uncertainty's doubled. Let's say we're going to see consumers cut back on spending. That would generate a recession. That recession will only really clear when uncertainty drops back down. I actually wrote a piece in terms of advice for folks out there. I wrote an article in the Harvard Business Review about a year ago saying there are 3 things you should do when uncertainty increases. Number 1 is try and pay for flexibility. So, for example, rent rather than buy equipment, take short rather than long leases, lease rather than permanently hire employees. Now, typically flexibility costs money. So, for example, if you sign a longer lease on a piece of, an office, or you buy a piece of equipment or lease it, it's cheaper in the long run. But when uncertainty is high, it's worth paying for flexibility. So, fact 1 is just go for short run leasing, renting stuff that's maybe more expensive but gives you flexibility. Fact 2 is particularly now is trying to follow what's going on, and currently a lot of uncertainty is coming from political movements, and so it's honestly just pay attention to politics and policy. There was an old saying, George Stigler, another Nobel Prize winner, said, the business of business is business. But it turns out right now that ain't true anymore. I mean, businesses have to get heavily involved with policy. Governments kind of, octopus-like involved in everything right now. And so the second thing is I think businesses really do need to pay attention, and maybe that involves lobbying. I mean, I hate to say it, it's not really what I feel is correct, but I think, lobbying expenditure and getting involved, et cetera, is valuable. And then advice 3 is to have an emergency plan. So there are various, horror risks on the horizon I could see. For example, I mean, President Trump could get rid of Jerome Powell. He could fire him. If that happens, I wouldn't be surprised that, the dollar drops 10%, the market crashes, who knows? You could see various illiquidity stays, markets freezing up, etc. There's other things that could happen. I would think of emergency plans. So, for example, I talked to some companies that had rough plans in place that weren't the pandemic, but had plans for that kind of thing, and they found it much easier to operate at high speed. So if your C-suite, your team has a plan, and then something happens, you can go to that plan and it takes you an hour to pull it out. It may not be perfect, but it's better than nothing rather than flapping around. So, pay for flexibility, follow politics in the news, and try and have contingency plans.
Okay, no, that's great. That's great. That's really helpful. You spoke about the role of uncertainty in business cycles in one of the research projects or research publications you did, talking about, so I guess the real question is, will the current shock reset the business cycle, and how does it traditionally play out?
I think this, of the policies I've seen to date, so again, we're in April 2025, I think it's going to do a couple of things. One is generate a short-run slowdown, possibly a recession. So, taking the IMF has predicted, as is Wall Street, as is pretty much everyone, a dramatic slowdown in growth. So I think GDP growth last couple of years has been 2 to 3%. We're probably going to see that drop by easily more than half. I wouldn't be surprised if it drops to 0.5%. So actually, growth per capita may even go negative. Normally, recessions are defined as growth, but the population is growing a bit still because of immigration. So one is there's going to be a short-run slowdown/recession. Second is, I think, longer run growth rates are tapering down. So if you look back, go back from 1950 to 2025, that's 75 years worth of growth, America did incredibly well. It grew much faster than Europe. In fact, if you invested in the US in 1950, you've done fantastically well. It's been a great three-quarters of the century for the US. If you look at what's driving it, it's been primarily driven by high rates of immigration, both skilled and unskilled, a lot of research coming out of universities. Think of the Magnificent Eight, all these tech firms, they pretty much all sprung out directly or very much built on university research. And thirdly, kind of low budget deficit, stable policy environment. All three of those, I think, are at risk. So I also, in the longer run, think US growth rates are going to be lower. So rather than traditionally we're seeing GDP growth rates of 2-3%, maybe we're going to trend down to, 1-2%. It's worth noting growth is already slowly declining. I had this paper I published in the American Economic Review in 2020 called "Are Ideas Getting Harder to Find?" pointing out that growth had been slowly declining for many decades. I think it's now going to accelerate. So both of those are kind of ominous. They're both why, for example, treasuries are not doing well. If you are holding US treasuries, lower growth makes it look like it's scary as to whether the government's going to pay that stuff back. And it's not clear. There are various ways, subtle and less subtle ways to default on treasuries, including, I don't think it would be formally called a default, but high rates of inflation are one way for the US to get out of it. If you have a massive burst of inflation, you effectively default in real terms, or taxes on foreigners holding treasuries, etc. So, I see short run pain, longer run right now, based on the first 3 months, I'm concerned over the impact on growth. But, things could turn around, but that would be my reading up until April 2025.
Understood. And I guess so I saw a piece of research recently, and this is again separating the just direct costs of tariffs from the more ambiguous costs of uncertainty, which are real costs. Every percent up, every 1% of tariffs was supposed to lower GDP by 0.1%, I want to say. And so adding 30% basically lowers GDP by 3%, which would take you negative, right? If they actually got up to those levels, which were the highest, those were the highest levels before a pause was placed in. So that was the straight up math. I don't think that took into account uncertainty. And then what you're speaking about, Nick, is basically companies just pausing and people pausing, which should increase it more. And then you kind of referenced, I'm curious if immigration even comes, if you have a recession, typically you have unemployment. And so I don't know if we could fill that vacuum just ignoring people coming into the country or not. But is that a fair assessment? Am I missing anything there? Is that kind of
No, you're right. I mean, I don't know the exact numbers, but my current employer has put a hiring freeze on for uncertainty. So exact anecdote. Yes, the numbers. In fact, today, as of April 21st, there's a piece in the Wall Street Journal saying while the markets are down and there's lots of doom and gloom talk, the actual numbers from the Bureau of Labor Statistics, etc., so far don't look bad. So it's still a bit of an open question. But as an economist looking back at the last 50 years of growth, what I see has been driving. You can hear from my accent, I'm British.
Yes.
Britain used to have the world's best two universities, Oxford and Cambridge, but they basically lost out to these elite American universities that had deep pockets and amazing infrastructure. That is now at risk. And that kind of thing is an immigration, the whole, if you look at the big, the Magnificent Eight tech firms that have been driving NASDAQ and most of the S&P 500 gains, either their founders are immigrants or they're heavily staffed and, employing immigrants, PhDs, et cetera, folks from India, China. So that kind of massive levels of wealth creation for the US will become harder. I mean, it's a question, look, there are ups and downsides. The UK voted under Brexit to make it harder to immigrate. So there are reasons why you may not want immigration. But I think in terms of growth, the prediction of that is relatively straightforward, which way it will go. And it's, cutting immigration is almost certainly going to be negative for growth.
Got you. Okay. And so there's also, so the Trump administration has invoked this tariff war, and this has invoked uncertainty. I believe you've also done some research into how to combat, I'll call it uncertainty and recession, which can also be positive policy that comes out of the administration. I believe wage subsidies was one of them. Are there tools the government can use beyond just saying like we're done with the trade war, to combat uncertainty and to kind of ready to get things, I guess, a little bit better.
So, I mean, generally
shift.
it would be
Yeah.
a stable policy. So, one view of it is the new administration, Trump administration, had lots of ideas. They came into power. They thought, look, we control both houses. Let's execute on our ideas. We have this honeymoon period, a lot of popularity and strength, and let's just push this whole agenda through. And under that scenario, by, I don't know, May, June, they've done everything they want to do. And then, things calm down, uncertainty drops back down. And so under that scenario, uncertainty will drop back down. We never get this uncertainty-driven recession. We have a brief surge in it. The alternative view is, I think their whole agenda is to be radical and, it's like almost Maoist, like continuous revolution. And it dominates the headlines and, keeps people alive and engaged. Under that view, uncertainty just remains higher. It's just a, feature of the way that policy is going to be. And that will for sure generate a recession because you're going to see just less investment, less hiring, less spending. And there's no real way around that. You could have said, why doesn't the government borrow a lot of money and spend to get our way out? But with debt as a share of GDP at 100%, and with our primary budget running 2-3% in deficit, I would not advise spending more money. We are, the US economy is now kind of like a teenager with a credit card close to max out. And a year ago, I'd have thought the concerns of the market, the US defaulting, were low to zero. Treasuries had, extremely high credit rating. Having seen what happened with the UK with Liz Truss, these things can turn sour very fast. And it's now a difficult situation because either we're going to have to put up taxes, which I don't think is going to happen, or cut spending, which would mean really the only way spending you can cut is to cut Medicaid, Medicare, Social Security, which is politically extremely difficult, or have some kind of default, like high levels of inflation. And I don't know. I'm kind of struggling to quite see how the US is going to pay back its debt. And so that's another kind of ominous thing on the horizon. And again, we saw in the UK with Liz Truss, eventually, bond vigilantes of the market, will force something out. And I think that could be ugly.
Got you. Okay. So I'm going to latch on to the first item just to try to end here on a positive note, but a realistic note. So I'll note that the idea of the Trump administration being in the news on a daily basis also played out in his first administration. I remember coming out of that first administration and then coming to the next administration, the Biden administration, and just thinking like, wow, nothing's going on. It's boring. So this was something that played out. It's part of their playbook. The Trump administration wants to be in the news every day. They were in the news in the first administration. I imagine uncertainty was a little bit higher, absent everything else in the world. But it felt more. Not every piece of news was the tariff event. And then kind of going back to what you just said, with the tariff event on the day that it was mentioned, kind of going all the way back to, the beginning of this podcast, the, Liberation Day announcement, that was claimed to be the high watermark, whether true or not to be seen, because again, there's risks in playing this tariff war game. But now countries are digesting it, businesses are just digesting it, and conceptually, the Trump administration is digesting it. They did create a pause, right? And that's part of it. You saw it even the first few months of this administration where we came out with tariff news on Canada, on Mexico. There was a pause, there was a go. It was stop, go, stop. It doesn't mean it can't get worse, but it's gotten a little bit better since. So if that plays out, does it come down to a mix of market participants and economic participants kind of getting used to it and figuring out how to navigate, plus the Trump administration, even with making sure there's news every day, kind of getting to the end? This one feels like a bigger one than most kind of initiatives that this administration has, where maybe the tariff wars play out, or is that just wishful thinking on my part and trying to end a podcast on a good note?
No, and you're right. Trump won. The news, this again, there was a bit of a Main Street, Wall Street divergence. Main Street, newspapers are full of stories about Trump was doing this and that and talking about uncertainty, whereas Wall Street remained relatively calm. And I think on that case, Wall Street was about right. So, he had the major corporate tax reform, which I thought was a good policy. One of the things, in Econ 101 is you want to actually cut corporate tax rates because capital is very mobile and you want to try and tax other things, shift taxes more to labor and property, for example. And so there are a bunch of things that were, there's a mix, Trump won, but he certainly, while he talked a lot of uncertainty, you didn't see nearly as much on the ground. Trump, too, has been very different. There's been an incredible, I think he just got a very strong mandate in November 2024. I mean, he won the popular election, he won both houses, and he won the presidency. It's hard. That was a very clear, strong Democratic mandate, and he's kind of executed on it. And so this feels very different this time around. I mean, there's also 8 years of difference, and politics have become more polarized, is more combative. He's had various lawsuits against him, feels angry. So, I mean, I'm not a pop psychologist here, but I think this is not Trump one. I think it's really a very different setup. And as day by day goes on, I have the feeling there is more big shocks, in the bag. I suspect there's a view of, what other policies do we have? And if the news cycle shifts to something else, let's, bring it back to focus on us by, unveiling another pretty radical change.
Okay, fair enough.
By the way, it doesn't have, as a trader, if your take, look, depends on what your position on the market, whether this is good or bad. I mean, if you're, I would be long vol, for example. I'd probably be short the dollar. I mean, these, who knows whether that's a good or bad strategy, but I'm not sure, this is necessarily, if you're actively trading, it's not necessarily bad. It's just you've got to get the positioning right.
Right. Longer term investors, it's a little bit more of a run, and then it just comes down to, okay, what does this look like 10, 20, 30 years, from now, and how exactly does this uncertainty play out? How does tariffs play out? What effect does it have on the dollar? What effect does it have on just America's position in the world? But maybe that's for another show. So, Nick, really, really appreciate you coming out. I'll tell you, we use the uncertainty index continuously. It makes a ton of sense on top of, you always want to kind of understand what's going on, what's the feel, and uncertainty has just such a material role in how markets price. So thank you at the least for that, and thank you for coming on today.
Joe, thanks very much. As I mentioned, we're continuing to roll out other, there's been huge demand, so we're about to put up a daily, economic trade uncertainty index, for example. Yeah, the market for uncertainty measures is also, that's one positive, area of growth, that's for sure.
No, I really appreciate it. And we'll put in the podcast liner where you can find the index. You daily, I think you mentioned before, is on Bloomberg. Is it anywhere else?
Yeah, there's a lot of our indices on Bloomberg. We have our own website, but you can go to Bloomberg. Also, Fred from the St. Louis Fed also carries a lot of this data.
Okay, we'll put both the notes out there.
Thanks very much.
Have a great one. If you like what we do, rate and review the show on Apple Podcasts or Spotify. Every positive review helps new listeners find the show. Send us the debate topic you are most interested in by emailing us at podcast@fountainheadam.com. Thank you to Fedi Smooney for production, Sarah Mance for marketing, and Dalton Morrow for research. I am your host, Joe Halpern, looking forward to our next investment war.
Fountainhead sponsors the podcast to further education and critical thinking about the factors that affect markets and investing, and the podcast does not provide investment advice. Investment advice is offered only to clients of Fountainhead who have entered into an advisory agreement and with whom Fountainhead has identified individual objectives, risk tolerance, and other investment needs.